Did you know that you can short sell options contracts? Well, if your answer is no, then you are in luck, because in this class, we are talking all about writing and selling options contracts. I'm Matt, Director of Education at Pennybois University, and welcome to class number 13 of Pennybois University LITE. This is class 3 in a 10-class series on options trading, part of PBU LITE, which is 100% free. Make sure to check the description in this video for the handout as well as a class video game. You can buy calls and puts, but you can also short sell calls and puts. Before we get into that, let's explain what short selling is. When you are short selling a stock equity, so not an options contract, just a regular stock, you are selling something that you technically don't own, meaning you are borrowing a stock from a lender and immediately selling it. So let's say that I'm shorting a stock that is $500. That means that I am borrowing that stock from a lender and then immediately selling it for $500. So nice, I have $500, but I also have an IOU to the lender for that stock. So eventually I need to buy that stock back and give it back to the lender. So my hope is that the stock goes down, let's say to $400, and then I can buy the stock for $400 and give the stock back to the lender. That's a $100 profit because I sold it originally for $500. However, if the stock goes up, then I will eventually have to cover, meaning buy the stock back to return it to the lender for more than I originally sold it for, meaning I would be at a loss. So if the stock went up to $600 and I didn't see it going back down from there, I might have to buy the stock for $600 to return it to the lender, which means I'm out $100 because I sold it for $500 originally. All right, so back to options. When you short sell an options contract, you are known as the writer, also known as the seller. You receive payment, which is the option premium. So the premium is 50 cents, you get $50 in exchange for accepting an obligation. The obligation for a short seller of a call option is to sell the stock at the strike price to the buyer if the option contract is exercised. The obligation for a short seller of a put option is to buy the stock at the strike price from the buyer if the option is exercised. The goal for short sellers is for the option to expire worthless, meaning that the stock does not reach the strike price by the expiration date and cannot be exercised, and the premium goes to zero. In this case, you get to keep the premium as profit. Another option is to buy back the option, ideally for a lower price than you sold it for, and if a short seller's losses is getting too big, they might cover, which means sell for a loss. When you buy back the option, you are essentially canceling your obligation. Short selling options can be very risky and isn't recommended for new traders. However, understanding how it works is important. Another way to use options is to write covered calls to try to limit losses. Make sure to tune into class 14 where we go over covered calls and puts. We also have a complete options 101 class in our free trading Discord, as well as an advanced options strategies 102 class in the premium area of the Discord, as well as educational options trading live streams with Q&A with veteran traders. I hope to see you there, but until then, I hope that you all make some bread.